Today, more crocodile tears from the RBA. Hello again, it's Martin North from Digital Finance Analytics Web Notice Post, covering finance and problem news with a distinctively Australian flavour. As I reported briefly over the weekend, Phil Lowe on Friday was in front of the House Economics Committee. And at one level, it was a bit of a replay from his earlier outing in the Senate, although I must say I think the questions were a little bit better formed this time, but we didn't really learn a lot more, nevertheless. But one thing that did come up was that the central bank said it's the level of the cash rate, not the speed it's achieved, that matters. Which actually, if you think about it, is quite interesting. The pace of central bank cash rate hikes since May last year doesn't matter, he said, but only the cash rate level achieved at the end of the day. Now, this second committee sitting with the RBA on Friday the 17th of February, Governor Phil Lowe, Deputy Governor Michelle Bullock, and Assistant Governor Lucy Ellis, and Assistant Governor Dr. Bradley Jones all fronted the Parliament. Speaking to the House of Representatives Standing Economics Committee on Friday, the RBA heads were asked a range of questions regarding the speed and size of the 9 consecutive cash rate rises and their impact on mortgagors. The RBA was asked, is there any economic research to support the suggestion that a slower rate of cash hikes could give you greater credibility? And in response, the Governor commented, I'm not aware that there is. It's really a judgment issue, given the media and political focus on the change in interest rates mostly, rather than on the level. The assessment we made was that this would keep people focused on the tightening of monetary policy for longer. I'm not sure there is any evidence that the transmission is different depending upon which sequence you follow. Dr. Ellis added,
I'm not sure there's any evidence that the transmission is different depending upon which sequence you follow.
Yeah, so what I can say in thinking about a path of getting, up, say, in round numbers, say 300 basis points over a couple of months versus in 25 basis point increments, if you put those paths at the beginning of a forecast horizon with any standard macro model, you'll get almost no difference. So from the perspective of interest rates to observable variables like output and unemployment and inflation, it really doesn't matter. And so the question is, what does that do to expectations? So one of the big variables that's important in a standard macro model is inflation expectations. But there's not a lot of good economic theory about how those expectations are formed, and many models have, quite arbitrary assumptions there. So the argument that was, has been, put in various discussions about whether it's maybe a bit better to go a bit slower, as well as the normal robustness argument that the Governor mentioned in an uncertain world, is the question of whether you're influencing expectations differently by having that narrative in the public mind. I mean, in the end, most people are not paying attention to economic news every minute of the day, and so by having, are you influencing their expectations more with a different path? I don't think there's definitive research on this, but I think there is actually a lot of active research on how expectations are formed, and there would be a credible argument for something like that being potentially influential on expectations. There's no good models of how expectations are really formed.
To clarify whether she meant that it doesn't matter if rates move more slowly or more quickly, Dr. Ellis confirmed not a lot. We're talking very small beer. And she elaborated, if you're talking about doing 200 or 300 basis points over 3 months versus 6 months or 9 months, then no, a quarter or two here and there does not matter. The transmission mechanism is not that big in the near term. That's the reality of estimated macro models. The exact path of where you get to doesn't matter that much, as in the speed of that. What matters is the level you get to. And also of interest to senators was the emotional and financial impact to mortgagors and renters, and how those are being factored into the central bank's decision. They cited Governor Lowe's own comment that he'd received such input from members of the public and organisations like the Australian Council of Social Service. And that's factored in as best we can in the decision-making process, Dr. Lowe assured them. But at the end of the day, our job is to make sure that inflation comes down. At the moment, that's our priority, and we think we can do it in a way that keeps people in jobs and keeps the employment right below where it was before the pandemic. But we've got to get inflation down. And there was also an update on home owner impact. While the RBA was able to explain much of its modelling to the Senate Committee to answer key questions, it said that one line of inquiry could only be answered in the release of upcoming data set for April. The RBA board members were asked if they had percentage data on the number of households using their cash flows to pay their mortgages, or if they were in negative cash flow. Mr. Jones replied,
So first of all, just to take stock of where things stand today, so a very, very small proportion, less than 0.5%, half of 1% of loans are in negative equity. When we run a stress scenario, if prices were to fall from this point another 10%, the share of loans that would be in negative equity would be 1%. If house prices were to fall another 20%, the share of loans that would be in negative equity would be around 4%. And a big reason for this is that loans during the pandemic were increasingly written at, quite by historical standards, low loan-to-value ratios. So that has engendered a fair amount of resilience in household balance sheets with respect to their ability to withstand a decline in housing prices without falling into negative equity.
And a related question, do you model how many households in that central scenario, and possibly, I suppose, also downside scenarios, because the central scenario is your best guess, but there's a decent chance of upside or downside. Do you model the likelihood of households going into stress, so a certain number of households with, say, more than 30 or 50% of their cash inflows going to servicing loans or going into negative cash flow? Do you model those kinds of scenarios?
Yes, Chair, we have, and in fact we published a fair amount of information around this back in October in the Financial Stability Report, and there'll be an update on those estimates in early April. Mm-hmm. What I can tell you is the picture is extremely uneven, which is a theme I think the Governor was picking up on. At the aggregate level, it looks like there's a lot of resilience. When we drill down across the full distribution of borrowers, we see a very uneven picture. On one hand, you've got around half of variable rate owner-occupiers who are more than 1 year ahead on their mortgage payments. In fact, about a third are more than 2 years ahead. At the other end of the distribution, we observe around 10% of variable rate owner-occupier borrowers who have got virtually no spare cash flow after they meet their mortgage payments and their living costs, also have very low buffers, and a reasonable share of those households are low-income households and hence have a limited ability to cut back on consumption because a lot of their consumption
and a geographic concentration of those?
That's right. So the picture is very uneven across households, and there's no question that there's a segment of the community that are hurting now, and that's very likely to continue, and that certainly features very prominently in our internal discussions.
Thanks.
The picture is very uneven across households, he added, stating that there's no question there's a segment of the community that is hurting now. That's very likely to continue, and that certainly features very prominently in our internal discussions, he confirmed. Now, that's all well and good, but of course, it's easier to say it at a high level. In my surveys, I see this in spades down on the ground, and one of the interesting observations is that in certain areas, for example in areas of Western Sydney or to the west of Melbourne, we're now seeing quite large concentrations of households in particular areas, all with similar problems. And there's a very interesting line of correlation between these financial pressures on households and falling home prices. So I am not sure that the RBA really has enough granular data to be able to fully understand the implications of what is going on. And frankly, I think personally that their macroeconomic models are too high level and too lumpy to be really getting to what's going on at the ground floor level. And by the way, many of the banks are still messing around with high level modelling too. So the question to leave you with today is this: who really understands what is happening to real households on the ground and how their cash flows are actually being impacted? The truth is that banks will see some of it, depending on what money comes in and what money goes out of a particular bank account. But the RBA will see some of it. But unfortunately, I don't think that the combined view across the regulators or indeed across the banks is sufficiently granular to understand what is really going on. The truth is this: we are at a tipping point. If rates go higher from this point, the number of households who will get into difficulty and stay in difficulty will rise almost exponentially now. And just to show you that, here is some modelling I did earlier on in answer to a viewer's question. Today, about 1% of households are in negative equity. In other words, the loan-to-value ratio is above 100%. But you can see from the modelling that if rates were to rise, let's say another 0.5%, then the people in negative equity move up quite significantly. And in fact, we could quite easily get to 300 to 400,000 households across the country in negative equity. And those very households are also ones where cash flow is a problem. So you can see the early warning signs of trouble ahead. I just wonder to what extent the regulators and the RBA do really have their finger on the pulse. I suspect that particular view might be rather myopic, to be polite about it. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.